Okay, good morning, everybody.
Good morning, sir.
And thanks for joining this class. If you have if you haven't subscribed to our YouTube channel yet, kindly subscribe and hit the notification bell. Also like I share this video. Enjoy your class. Mr. Abdulwasi is your lecturer today. Mr. Abdulwasi, you can start.
Okay. Good day, everyone, and welcome to today's class. And today we are going to be talking about what business organization and what and stakeholders. And firstly, being the first time I'm taking this course and being the first topic, one of the first things that you have to do, especially when you're writing a professional exam, in terms of there are some things that it is not necessary for you to read it before you can answer it. But what you just need to strive for is for you having a good understanding of it. Because majority of things here, they are basic work, they are theoretical course. So the key things here, the key driver here now is for you to understand it. And most of the time that you'll be coming across is things that you are aware of it before. So the only thing that you just need to pray for now is for you to ability for you to be able to think in the exam. So when we say business organization, is everything that we all know it. You all know a business organization. You have seen them before. And when we say stakeholders is things that you yourself, you are a stakeholder. So now that's basically what we are going to be talking about today, which is what business organization and stakeholders. And what are the key learning objective of this? We are going to identify and explain different objective and the legal form of business organization. That is, majority of the time, one of the objective of business organization, especially the commercial, is to make profit. While to the public organization is to render essential service. And will also be described with example the main categories of stakeholders. Sometimes we can have the internal stakeholders, we can also have the external. And also we are able to explain how organizations collaborate to achieve a competitive advantage. So at the end of this class, you should be able to ask yourself these three key objectives that you understand. So now when we say business organization, firstly starting with what can organization? An organization is the institution or association comprises of individual who have comprises of individual who have the same we have the same goals and objective. That is, everybody will come together now just to do just to have the same goals and objective. That is what everybody is striving for. If you establish that organization, we have the same motive. That is the reason for you establishing that organization, whether it is an individual or it's a group of individuals, is for you to have Is for you to have the same, all of you have the same motive. And your motive may be different. Your motive sometimes is to render service to the public. Majority of your motive sometimes is to make profit. So when we say organization is an institution or association comprises of different individuals who have a collective goal and is linked to external environment, which we are still going to talk about this external environment. When we say external environment is a type of environment that organization does not have control over. That is your external environment. You can only go along with it. You can't control it. So you have to play along with what is happening in your external environment, not just so that you not achieve what we call strategic drift. So when we say business organization are firms or establishment that organize factors of production to produce goods and services which are used to satisfy human wants. A firm is is a single production unit. That's a business organization. What business organization does is to coordinate or sometimes to establish the factors of production. Let's bring them together so that we are going to produce, whether we are producing goods or we are going to we are going to render service, which are used by which are used to satisfy human. And when we say factors of production, all of us can still remember this. That is, we have the we have the labor, we have the capital, we have the entrepreneur. So, and basically, organization can be divided into two. We have the commercial organization, and we also have non-profit making organization. Please don't forget, organization can be divided into Can be divided into two. We have commercial, and we also have non-for-profit making organization. So starting with the first one, which is commercial organization, and every one of us here, this is the most popular form of organization that you can see nowadays. It is commercial organization. And one of the reason commercial organization, they say those are organizations which engage in business activities for the purpose of making profits. That is, this organization, the main reason of establishing this organization is to is either to sell goods or to render service. But the main thing, the key motive here of you thinking about, okay, let me register my business organization with Corporate Affairs Commissioner, is to is to make profits. So, and another thing has to do with And what are the characteristics of this organization? The characteristics of this organization, one is to is to make profit. That is, the purpose is to make is to make profit. Another characteristics of this commercial organization has to do with the ownership. That is, this company is being owned by It's being owned by investors who provide who provide the capital, like you are the shareholders. And another one has to do with another characteristic has to do with the sources of finance. That is, how did this commercial organization get formed? Because every organization, once you are planning, okay, I'm planning to have this organization, you have bring up a good business plan. Another thing that you have to be, which is very crucial, is the sources of finance. That is, where do you want to get this money from? Are you going to rely on yourself? And that's why when we were talking about a little bit of financial management, okay, should I go for equity base, or this company should be a share company, whether I'm going to provide my own capital and I also rely on debt? So the sources of finance is very, very important. That is, where are you going to get the money from? Is it only from from the investor, which is the shareholders, or I'm still going to be borrowing from other financial institutions, in case of bank? And another characteristic that has to do with the management. When we say the management here, is that those that run the company on day-to-day basis. And the managers are those that managers are those that run the companies, or sometimes we call them the board of directors. And it is because of this that will lead us to what we call the agency theory. Because under the agency, we have the principal, and we also have the agent. The principal here is the shareholders, or sometimes we call it the provider of finance. Why the agent is is the director, or sometimes we call them the board of directors, or we refer to them as management. In corporate governance, we'll be referring to them as board of directors. Board of directors are the agents that will be managing the day-to-day activities of the business. So this is commercial organization. This is a characteristic. Please don't forget. We have the purpose. That is, why are you establishing this organization? The purpose is to is to make profit. Another characteristic has to do with has to do with the ownership. That is, this company is owned by who? Okay, it's owned by investor who provide the capital. The source of finance, maybe through the shareholders' contribution, or we can still rely on debt. And another characteristic has to do with the management. So another thing that has to do with what we call under business. No, we say business organization can be divided into two. We have what we call the commercial organization, and we also have what non-profit making organization. And under the under the commercial, we'll be talking about what the first one, which is commercial organization, which is we have talked about it now. Another thing that we also go to that we also need to talk about is what the business entity. And when we say business entity, this is a commercial organization which motive is to make profit from its operation. That's another, let's say another subdivision of what commercial organization called what business entity. And here, based on our syllabus, we'll be talking about what these three, which is what we call what sole proprietorship. We have the partnership, and we also have the companies, which is sometimes the limited liability company. We all know this when we say sole proprietorship business, or sometimes referred to as what one-man business. In terms of when we say this business organization is being held by what? By one person. When we say you are a sole proprietorship, that's what is a one-man business. But when we say partnership now, partnership is not a one-man business. We can be what? Let's say everybody here online now. Okay, me, you, let's say we can be like 10. That okay, we form what? We form a partnership business. But under sole proprietorship is just being formed by what? By one person. But under partnership, it is what? It can be 10, it can be what? It can be more than that. Then we have what? We also have another one called companies. And this one can also be divided into two. We have some companies that are what? Private, and we also have some that are what? That are public. It is a private that you are going to have LTD, that is limited. It is a public that you are going to have what? PLC. So please don't forget this. Business entity can be divided into these three. We have the sole proprietorship, we have the partnership, and we also have the company. The company can now be subdivided into two also, which is we have the what? And we have the private, and we also have the what? We also have the PLC, which is the what? The public. It is a private that was hand with what? LTD. Why it is a public that will hand with what? PLC. So when we say sole proprietorship, they say this is a type of business entity owned and managed by what? By one person. It is owned by one person. We call it what? One-man business. And another one, which I always explain briefly, is a partnership. So this is what is a business organization formed by two or more persons who share ownership of the business. This is maybe what? Two or more. It can be 10. But you are going to contribute your own idea. You are going to contribute your own finance. Me also, I'm still going to contribute my own finance. I'm still going to contribute my own idea. So that's partnership. And I'm very sure everyone here today, we all heard this before. This is not new to us. So, and when two or more individuals is acting together, there's a need to have a what? There's a need to have a agreement that is going to bind them together. So in a partnership now, the agreement that is going to band each of the partners together is what we call the partnership deal. Sometimes we refer to as what? The deal of partnership. And you are still going to learn this in your financial account to some of us that are still writing it, or if you are not writing it, you could have aware of it before. We have the partnership deal. And what are the content of this partnership deal? The partnership deal is going to show whether there's going to be anybody that will be remunerated. Maybe if there's going to be any remuneration to any of the partnership deal is going to contain that. If there's going to be interest on capital, it's going to be interest on withdrawing, the interest charge, that is the percentage. Interest on drawing, the percentage interest on what? On capital. How are we going to share the profits? So partnership deal, these are some of the content of what? Partnership deal. Whenever two or more individuals is acting together, there's a need to have a what? There's a need to have a document that is going to bond them together. And this document is what we call the partnership deal. And we also have companies. This is the third one. I said this is an incorporated business organization where this business is what is different from the world, from the owner. And this is the most popular form of business nowadays. And it's as a result of company that we have what? Corporate governance. Because under company now, the management of the business is different from the owner. We are still going to talk a little bit of corporate governance in this syllabus. And one of the reasons why we need to have corporate governance is as a result of what? Separation of ownership from what? From control. As a result of what? Agency theory. Let's say, for example, now you always go to work Monday to Friday, but you still have some supermarket that you are running. So you can employ someone now that, okay, me, I'll be going to work on Monday to Friday. You are going to be helping me to open the shop. You also be the one that will open it. You also be the one that will close it. So there's that need to have a governance now. That is going to what? Governance is just meant to check now the whole who is helping you to stay in your what? In your supermarket now. Because what corporate governance is meant to do is so that the director now or the agent, the person that is helping you to stay when you are not around, so that it will be acting in your what? In your best interest. So it's as a result of company that we have what? Governance. Because of what? The ownership is separated from what? The management. Some of us here too we can have shares in some of the listed company. But you are not the one, you just buy share and you what? And you go. And you'll be waiting for what? You'll be waiting for the AGM, whereby they are going to, maybe they will declare dividends or not. You are not the one that is managing the day-to-day activities. So when we say companies are what? It's a business organization where the business is different from, that is where the management, you can put it like that, where the management of this organization is different from the what? It's different from the owner. So please don't forget. And I told you earlier that we also have this company can be divided into two. We have the word the private, and we also have the word the public. And it is a public that will end with what? PLC. Please don't forget. Why? It is a private that will end with what? Limited. And when we say a private limited company is a company stated in what? In the Memorandum of Association, having the what? Having the following feature. It is established by two members. That's the minimum. Please don't forget. The minimum to establish a private limited company, the minimum member is what? Is two. That means that me and you can form a private limited company. And the maximum is what? Is 50. Don't forget. The maximum is what? Is 50. And another features of what? Private limited company is what? Is there's a what? Restriction on share transfer. In terms of you can't transfer share from one person to another. No, it is not what? It is not allowed. Another one is that it cannot sell shares to the members of the public. That is, you can't sell your share to the members of the public. You can't have prospectus. Because for you to have, that's another document, that's another vital document in business organization. That's what we call what? Prospectus. And prospectus is what? Is a document that is PLC usually used to invite what? Members of the public to subscribe for their share. So under a what? One of the features of private limited company is that it cannot sell shares to the members of the public. And another features is that the company ended with what? With limited. That's why you have what? LTD. And I've made mention of this before. So please don't forget this. It is established by two or more. It is the minimum is what? Is 2. The maximum is what? 50. And another one is that you can't transfer share. You can't invite the members of the public to subscribe for your share. And it will end with what? LTD. Another one is what we call what? The PLC. It is what? The Public Limited Liability Company. And this is where our focus is usually be. That is in regulation. We usually focus on what? In law, most of the law that we have, maybe it's a corporate governance law, it is CAMA. Our attention is usually given to the what? To the PLC. So please don't forget. Attention is usually given to what? To PLC. Why? Because one of the reasons why we usually pay attention to PLC is because one of the reasons is because of what? The numbers of people that are your what? Shareholders. Here, if it is a what? If it is a PLC, the minimum member is what? Is 2. And there's no what? There's no maximum what? There's no maximum member. That's what? Is infinity. So that's why, please don't forget, in laws, in most regulation, our attention is usually given to this what? This PLC. Because the reason is that your member is what? Is unlimited. In the private, it is just what? It is just 50. But in PLC, it is what? It is unlimited. It is infinity. So what are the features of what? Of public limited liability company? One of the features is that a company can sell their share to what? To the members of the public. You can go to the Nigerian Stock Exchange on Monday now, or you have a broker. Then you're going to buy their share. And another one is that the general populace cannot deposit money with the what? The general populace cannot deposit money with the company. The share can be what? Can be transferred in accordance with the requirement of karma. But it's just the opposite of what? Just the opposite of the first one, which is the private. Because in the private, you can't transfer what? You can't transfer shares. Another one is that it ends with what? It ends with PLC. And another feature is that it shall obtain memorandum of association, article, and certificate of incorporation and certificate of what? Trading. So these are the brief features of what? PLC. And another very important document that we also need to talk about is what? Memorandum of Association. Memorandum of Association. And please don't forget this. It's very, very important. And sometimes the examiner can ask you what are the content of what? Memorandum of Association. And when we say Memorandum of Association is a document that will show the relationship between the companies and the outside world. That is a what? It is a document that will show the relationship between the companies and the outside world. But the opposite of it is what? Is Articles of Association. Articles of Association is a document that shows the way the company is going to be run internally. That is it's the internal document. But Memorandum of Association, you can refer to as well as external document because it shows the way the company is going to what? We are going to behave with the general public. We are going to relate with the outside world. So Memorandum of Association is a document that shows the work, that show the relationship between the companies and the outside. And you can see here, they say this is a constitution of the company. The Memorandum of Association is a document that regulates the relationship between the company and the outsider. It is the external party. This document must be assessed by the public at any time at the Corporate Affairs Commission. Therefore, it is a public document and consists of the what? Consists of the following. So let's look at the content of this memorandum now. It's going to Memorandum of Association is going to tell us whether the company is a what? Is a limited or it is a what? It is a PLC. It's going to tell you whether it is a what? Is a PLC or it is a what? It is limited. And another feature of or the content of Memorandum of Association is it states the objective or the purpose of the company being established. That's the word. It states the objective. It states the purpose. It states your mission statement. When we say, we can also refer to it as well as mission statement. When we say mission statement, and it's the purpose of establishing that organization. Everybody have mission. Everybody have purpose. So your mission statement now, which is your purpose of establishing that organization, your memorandum of association is going to state that. And another one features is that it states the liability of the members. That is, it's going to state the liability of the member, whether it is the limited or it is going to be what? Unlimited. That is the liability of the member, whether it is going to be limited or it's going to be what? Unlimited. When we say limited, in terms of if there's any problem in the future or there's any liquidation or there's any problem, the owner, if it is limited, if the liability of the member are limited, that means that you can only lose the amount that you have contributed. You can only lose the amount that you have contributed. If it is if it is limited. But if it is unlimited, in case there's a problem in the future, you are going to lose your money and you can be asked to even sell your private property in order to offset the debt that the business organization is owing. So if it is limited, in case of any problem, you can only lose the amount that you contributed. Let's say you contributed 10,000 naira now. So that means that you can only lose 10,000 naira. But if it is unlimited, you can lose beyond you can lose beyond the capital that you contributed. Another feature is that it specifies the name of the shareholders and the numbers of shares they hold. Memorandum of Association is going to show that. And very soon, I'm going to show you what? I'm going to show you an annual report where you are going to see some of these things. It shows you what? The total authorized share capital. When we say authorized share capital is the total shares that you have. And don't forget that share is measured in what? In units, not in numbers. You can't say 1,000 shares. You can only say what? 1,000 units of shares. So this memorandum of association is going to show you what your authorized share capital, whether it's what 100 million, it's 50,000, so amount like that. Or it's another document that we also need to talk about is what is articles of association. Articles of association, and these documents state that state the internal rules and regulation according to which the company will be governed. No, I told you earlier that this document is what is internal document, but memorandum of association is what is external document. So this document state the internal rules and regulation according to which the company will be governed. According to which the company will be governed. And this article contains what the organization was objective. So what are now the features of of these articles of association? These articles of association is going to tell you the notice of meeting. It's going to tell you the director and their appointments. It's going to tell you the procedure of what company's meeting. That is, how do we organize meeting? It's going to tell you the financial audit of the company. That is our financial statement. It's going to tell you how on the means that the way you can transfer shares. It's going to tell you the liquidation and the winding up process. When we say liquidation and winding up, is the coming to an end. But we don't usually have this assumption. The assumption that we usually use in accounting is the going concern. But going concern in terms that the business organization will continue to operate for unforeseen circumstances. Sometimes you also need to use breakup basis. Because if you have assessed that the company cannot be a going concern, so you need to use your breakup basis, and that's what the liquidation and the winding up process. The articles of association is going to state it. The borrowing powers of the companies. The borrowing power, can you borrow? So these are the key features. Please don't forget this. It's very, very important. The examiner can ask you what are the content of memorandum, or what are the content of articles of association. So another, we know in earlier aspect, we talk about the business organization can be divided into two. We have the commercial, so we have talked about the commercial now. So it's now left for us to talk about the non-for-profit making organization. And we all know this. When we say not-for-profit making organization, that is, this organization, the main purpose of establishing this organization is not to make It's not to make profit, but to render service to the members of the public. It's not to make profits. We are not here to make profit, but to render service. And most of not-for-profit making organizations are being owned by government, and sometimes we can have what we call the NGO. We have some good individuals, some competent individuals. They will be trying to solve the world problem. So not-for-profit making organization can be divided into two. We have the public sector, and we also have non-governmental organization that we call NGO. And when we say public sector, it's being owned and funded by the government. Sorry, when we say public sector organization, it's being owned and funded by the government. But when we say NGO, there are some NGO that are partly or wholly funded from government. There are some NGOs that are government. There are some NGOs that are not government. So what are the characteristics of this non-for-profit making organization? We have the purpose. The purpose is not to make It's not to make profit, but to render essential service to the members of the public. Essential service relating to maybe relating to selling of goods and services, or rendering of service. So, but our purpose of establishment is not to Is not to make profit. So we usually assess profit, not-for-profit making organization. That is one of the tools that we usually use to assess non-for-profit making organization is through what we call what value for money audit. Value for money audit. That's what we call what the 3E. We call it value for money audit. That is, your purpose is not to make profit. If it is a private organization now, we can be using what? We can be using their profit to what? To measure them. We can be using some other modern accounting technique like the balance scorecard, like the building block. It is still like that. But here now, we are only using what? We are only using the best tools that we usually use. And this is the most popular one that we usually use to assess what? Not-for-profit making organization is to use what? We have what we call what? The value for money audit, which is what we call it the 3E. Please don't forget, whenever you hear the 3E, you can also call it what? The value for money audit, which is we have what we call the what? The first E is what? Economy. Economy. We have efficiency and we also have what? Effectiveness. Economic refers to operating in a way that does not waste money. It is getting the best input at the cheapest price. That's economy. If you are buying things at the lowest price, that means that you are achieving economic objective. That is getting the input at the what? The lowest price, operating at the what? At the lowest cost. There should not be any element of what? Waste. But if you are getting in management, you're getting something in what you're talking about, what? Low price. You're getting your input at low price. You should also what? That low price should not compromise what? The quality of it. If you want to be buying something at 15 naira while others are selling it at 200, always have it at the back of your mind that the quality of the product should supersede the cost. But economic is what? Is getting it what? At the cheapest price possible. But if you are trying to achieve economy, have it at the back of your mind that the quality must not be compromised. So another one has to do with what? Efficiency. Efficiency refers to using resources in the most efficient way possible and getting the most out of them. It is the resources that you're using. You should be able to get the best use of it. Another one has to do with what? Effectiveness. Effectiveness refers to using resources and spending money so as to achieve the target and what? And the objective. So that to achieve your goals and your what? And your objective. So this is the purpose and this is the what? This is the measurement what? Criteria. We have another thing that we have is also what we call what? Ownership. That's another characteristic. Ownership. That is, public sector organizations are owned by government, while cooperative are owned by what? Members, and cooperative society too. The sources of finance. The sources of finance of public sector organization is from what? Taxpayers' money. It's from what? From taxpayer money. Why charity rely on what? Grants and donation from government and private sources. If it is NGO, they rely on what? On grants and your what? And your donation. And another characteristic has to do with what? The management. The management is being managed by what? It's being managed by board of directors. So this is what? This is not for profit making organization. Please don't forget, not for profit making organization can be divided into two. You have the public sector organization, and we also have the what? The non-governmental organization. And please, I want to give you a certain task now. That is the first characteristic. We talk about purpose, ownership, the sources of finance, and what? And the management. So, and the purpose now, and talk about what? Value for money audit. That is, these are the what? These are the tools that we use to measure what? We use to measure public sector organization. So I want to give you another task now, which is I want you to read. There's another tools which we call what? Best value audits. Please read about it. Best value audits. Best value audits. There are two, but the most popular one is what? Is value for money. But there's another one that is in audit when you get to skills level. We call it best value audit. So please, I want you to want to read about that, which is what we call best value audit. And thank you very much. So we also have another one, which is what? Classification of what? Economic activities on occupation. You know, when we say economic activities of individual can be cut. That is what people do for living. What do you do to feed yourself? What do you do to feed your family? Can be divided into what? Can be divided into three. That is what you do for a living. That is your what? Economic what? Activities. So economic activities can be divided into three. We have the professional, we call it vocation, we have the employment, and we also have the business. Please don't forget, when we say economic activities are what you do for a living, what you do to feed yourself, what you do to feed your family is what? That's your economic activities. So economic activities can now be divided into three now. We have the professional, we have the employment, and we also have the what? We also have the business. So let's start from the first one, which is professional. They say this occupation involve what? Provision of what? Service of a specialized nature. Provision of service of a specialized nature based on what? Professional what? Education, training, and what? And experience in a specialized role. That is, as a chartered accountant, you're a professional. That is, you provide a special skills. You're a professional. It is, you provide something that is very rare, something that is very, very what? People can't do that. So what are the features of a professional? It is occupation from which one has to acquire a special knowledge and skills. Like what you are doing now is a professional. You are acquiring skills. You acquire experience also. Another one has to do with what? Professional usually provide a service to a client in a return for a what? For a fees. That is, if I'm rendering service for you, like this class now, you may pay for it. That's what you are going to pay a fees in return for providing that service for you. You can have what? Task consultant. If you are not good in tasks, you can employ me. I can be your task consultant. But for me rendering that service, you are going to pay me a fees. And another one is that most professionals are usually regulated by what? By a professional body, like ICANN, which is our own it's our own professional body. We have ACCA, we have the rest. We have another one, the features have to do with the regulatory body has the authority to discipline any professional members that breaches the code of what? Conduct of the regulatory body. That is, if you do anything that is what? That does not, I can't say, okay, you can't do it. And if you do it, there's going to be what? A sanction. That is, this professional regulatory body can sanction their member. They can withdraw your membership certificate. They can ask you to pay the penalty. So another one, the professional often establish their own thing and charge a service for their what? For their service render. This ICANN online institution now is a professional body. And for service that we render here, you pay a certain fees. So another thing has to do with that's professional and that's the future. Another economic activity is all this employment. And you all know this, and this is the most popular one. Employment, where you are going to be employed. You'll be working for what? You'll be working for someone. You'll be employed by someone called what? Employer. While you are working on behalf of your employer, you are the what? Employee. For example, now I'm employee of what? Of ICANN Online. So ICANN Online is what? It's my employer now. Me, Yada Abdulwasi, I'm the employee. So what are the features of these economic activities also? The person known as what? The employee work for another, known as what? As employer. Employee receives salaries and what? And wages. That's another feature. There's usually employment contracts, which bind the employers and the what? And the employee together. You can remember under partnership that I talk about, or partnership deal. That is, whenever two or more people are involved, there must be a certain agreement that's going to bind them together. Another one has to do with what? The motive for seeking employment is to secure and assured income, virtue of what? Wages and what? Salary. That is the main purpose of you saying that, okay, I'm looking for work, is to get what? To get wages, so it's to get what? Salary. And another features of employment has to do with what? Either party can terminate the contractual relationship, giving adequate notice as specified in the contract of what? Employment. At least you can tell your employer that I'm not more working for you, I want to go. But you can terminate it at any time by giving a notice to them. So that's it. So that's okay. Another one that we also need to talk about is business. And when we say business is an organization that organizes what factors of production, you all know this. I think I've explained this before also. And what are the features of a business to make profits, to what? It can activities where a person engage in manufacturing or selling of goods. It involves investment of capital before it is what? Commencement. Every business involve element of what? Risks. And that's very, very important. Every business involving risks because every organization that you have, there's element of what? There's element of risks. There's element of risks. Everything, even in our daily life also, there's risks. Another thing that has to do with transaction must be continuous to be regarded as well as business. Transaction must be continuous to be regarded as business. This is what you are doing. It must be something that is continuous based. Keep doing it. So a business is an organization that organizes factors of production to what to produce goods or to render what services or human worth. I think we have talked about this before. And what are the futures to make profit? So what there's kind of activities where a person engaged in what manufacturing or selling of goods or what service. It involves investment of capital before it is what is commencement. You have to put something. You don't just say, okay, I want to establish a business organization through the word of mouth. There has to be what the finance has to be there, and that's the most important. The finance. Every business organization involves element of risk. This you can see the first future is to make profit. This profit is not certain. You may not be able to achieve it. You can achieve it. You may not be able to achieve it due to what? Due to risk, due to uncertainty. And the transaction must be what continues. It must be something that you keep doing it. So that's all about what business organization. Please don't forget business organization can be divided into two. We have the private and we have the commercial and we have the non-for-profit making. The commercial is divided into we have business entity like what? Like the sole proprietorship, like the partnership, and like that of company. And we also talk about this company can be divided into two. Can be divided into two. We have the private, and we also have the public. We also talk about the memorandum of association, and we also talk about the article. Please don't forget the content. It's very, very it's very, very important. So another thing that we also need to talk about today is about what stakeholders. The topic is about a business organization and stakeholders. Business organization and what stakeholders. So now we need to talk about our stakeholders. And when we say stakeholders is anybody that will be affected by any decision or any action that the organization take. That means that if that business organization take any decision or take any action, if it is going to affect you, that means that you're a stakeholder. Please don't forget. If that business take any action or make any decision, if it is going to affect you, that means that you're a stakeholders. Don't forget that. So, and stakeholders can be what? Stakeholders, please don't forget, when we say stakeholders is anybody, just put it like that. Is anybody or any individual that will be affected by any decision or any action that organization take. That means that, for example, and let's say now, Dangote if Dangote make any decision or take any action, if it is going to affect you, that means that you are stakeholders. And stakeholders can be can be a group of organizations, it is internal, and it can also be a group of people. That is, stakeholders can be just individual, and it can be a group of individuals. So stakeholders can be divided into some textbooks will say 3, some will say 2. Now we have internal stakeholders, we have external, and some texts will also say we also have what we call connected stakeholders. We have internal, we have but the most popular classification is usually on internal and external. But there's also another classification called connected stakeholders, making 3. So internal stakeholders, we have the shareholders. And we say internal stakeholders within a business organization. We have the shareholders, we have the executive directors and senior managers. We have the other managers and current employee. So these are internal stakeholders. When we say shareholders, you all know this. Shareholders are the provider of the finance. They are they are the shareholders. Executive director, senior managers. And when we get to corporate governance, we'll be talking about these people in more duty also. That is, this executive director, sometimes whenever you hear director, whether it is executive or sometimes we also have what we call a non-executive director, we refer to them as well as agents, because they are the one that is acting on behalf of these four stakeholders, which is what shareholders, because the shareholders are not the one that is managing in most companies, especially in the PLC. The shareholders, there's a separation of ownership from control. You are the one that provided the fund, but you are not the one that is managing that is managing the business activities. So the shareholders in the large companies, the main shareholders are not usually involved in the day-to-day management, like I said earlier too. The shareholders in large companies are usually investor seeking to earn a return on their investment in form of dividend and higher share price. And we all know this from our elementary studies, that the reward of a shareholder is dividend. The reward of shareholder is dividend. The reward of a shareholder is dividend and high share price. That is, if you buy the share price 15 naira today, you'll be hoping for the share price to be 100 naira tomorrow. So, but sometimes shareholders also have their claim. There's what we call shareholders claim. And when we say shareholder, or sometimes refer to as stakeholders claim, please don't forget this. When we say stakeholders claim can be divided into two. There's what we call direct claim, and there's what we call indirect claim. Please don't forget, my people. There's what we call direct claim, and there's what we call indirect claim. When we say direct claim, when we say stakeholders claim can be divided into two. There's what we call direct claim, and there's what we call indirect claim. Direct claim is when a stakeholder is talking through his own voice. That is, nobody is talking on your behalf. You are the one that is saying it by yourself. So that's what we call direct claim. So a shareholders now can express their concern on these following matters. That is, for example, shareholders might express their concern about the following. That is, when can stakeholders talk? When the falling in profits and falling in share price. If the company is not making profit again, you can talk to the director that what is happening. We have been making profit since like 2 years now, but since the past 2 years now, we have not been making profit. What is happening? What about if there's a lower dividend? That is, the dividend they paid last year was 15 naira per share. Now they are paying 13 naira. What has happened? When there's a proposal to invest in a major project where the business risk is high. Don't worry, when you get to financial management, we'll also be talking about these business risks. So you can raise your concern in any of these following matter. There's a falling in profit, falling in share price, lower dividends. When there's about to be a new investment, but the business risk is high, you can talk to the director. Oh, business risk is high. Why do you want to invest in such project? And another thing is where a proposal takeover bid for another company or from another when maybe there's going to be a mergers and acquisition, or there's going to be a takeover. So these are instances where shareholders can raise their concern. And another stakeholder is also what we call the executive director. Executive director and senior manager. The board of directors may consist of executive director, and we also have what we call the non-executive director. Executive director are usually the full-time workers. That's the name we're giving them. Executive director, they are full-time workers. They are always there every day, Monday to Friday. They always come. But non-executive director, sometimes in corporate governance, we don't just call them non-executive director. We call them what? Independent non-executive what? Director. So these people can also raise the interest of what? The interest of executive director and senior manager are affected by matters such as their remuneration, the powers and the status, the career prospect, and the job security. This director, they're also working on behalf of the company. And it is the shareholders that will appoint the what? It is the shareholders that will appoint the director. The shareholders that appoint what? That appoint the director. So the interests of the executive director and senior managers are affected by matters such as their what? Their remuneration, the powers and the status, their career prospects. That is, if I'm working in that organization, you're going to be giving me a certain training. There's going to be a lot of I'll be attending seminar whereby the company that will be paying. We have to have the job security too, which is one of the most important things. Job security in terms of you can't just fire me at any time. I should be able to have a job security that this employment is what it is secure. So another stakeholder is also what we call managers and an employee. Managers and employee. Manager in the middle and the junior rank of the management hierarchy might have ambition to become a senior manager. However, their interests and concerns are different. Often, junior managers and other employees are common interests as that is what is the interest. And we are still going to talk about this thing in the next next slide now. That is, you see, each of the stakeholders, they have different things that they are looking for. And that's what creates problem. Because what the executive director is looking for is different from what the shareholder is looking for. It's different from what these managers and employees are looking for. Look at what this one is concerned about. It's concerned about the pay. Okay, will you be paying me very well? It's concerned about the working condition, the job security, the job satisfaction, the quality of life. That is the pay. Are you going to pay me very well? What about the working condition? What about the job security? And this, under human resources, which we are still going to be talking about when we get to motivation, there are sometimes employees are not really usually care about the pay. If you are paying them salary, a good salary, that's not enough. They still need another thing in terms of they need what? They need what? Working condition. That is where you are working is very, very good. The working environment is fine, it is cool. The job security is that if there's a word job security that you can't just fire me at any time without a due notification. There's going to be what I'll be thinking about job satisfaction. Okay, the work that I'm doing is not really it's not really much. Oh, I'm satisfied with that. What about the quality of life from that employment? So these are what managers and what employee will be thinking about. These are their own concern. Now, will the company still continue to be able to pay me the salary? What about the working condition? What about the job security? What about the job satisfaction? What about the quality of life from that employment? So we also have external stakeholders. External stakeholders can be lenders, that is the borrowers. Lenders can be like the bank now, that is if the bank borrow you money, they are external stakeholders. What about the suppliers? The suppliers, the government, your customers, the local communities, the general public, the non-executive directors, and the potential investors. So these are These are external These are external stakeholders. These are external stakeholders. The lenders, that is the borrower, sometimes we can refer to as the provider of finance, or sometimes the borrowers, that is the person that borrows the fund to carry out your business. The suppliers, the government, the customers, the local community, general public, the non-executive directors, and the potential investor. And the problem in stakeholders is that you can see there are many, but the problem is not as if because there are many. The problem is that each of them is demanding for different things. What the lender is looking for is looking for is different from what the supplier is looking for. It's different from what the government is looking for. It's different from what the customer is looking for. So the problem is that it's not because there are many. The problem is that because the need of each of them is different. And there's a management scholar that is trying to help us to solve those problems, which we are still going to talk in later section now. So another classification, like what I said, talk about earlier, is what after internal, we have external, and we also have what? Connected stakeholders. Connected stakeholders, we have what? They say, when we say connected stakeholder, other stakeholder group, other than the director, the senior management, and the shareholder might influence the decision that the director and the senior management take. The term connected stakeholders mean stakeholders who is not a decision makers. You can't make the decision. It is not a part, it is not a part of the it is not part of the permanent full-time infrastructure of the company. That is, it's not a full-time workers, you're a part-time. And it's nevertheless very influential in shaping the futures of the organization and the decision of its lenders. It is nevertheless, you are not you are not very important. You can't make, you're not a decision maker. You are not a full-time workers of the firm's infrastructure. And what are the example of what connected stakeholders? We have the non-executive director, we have employee, we have what key suppliers, we have what key customers. So these are, please don't forget when you say connected, these are another what? These are another classification. That is, we have internal, we have what external, and we also have what connected. A connected stakeholder means a stakeholder who is not a decision maker, it's not a part of permanent infrastructure of the organization. It's nevertheless, it's not shaping the futures of the organization and the decision of its leaders. And the main, we have the non-executive, the employee, the key customer, and we also have the key suppliers. So another thing that we also need to talk about is the reason for classifying non-executive director as external. That is the word denied. Or perhaps the non-executive director are external stakeholders in the company, or through the members of the board director. They are not a full-time workers. There are some texts that will call these external stakeholders. There are some that will call them connected stakeholders. And if you can look at the term partner, I say note. Okay, hold on. That the main stakeholders are those who exercise the great influence, usually the board of directors. Why the connected stakeholders who are not decision makers, but highly influential in the decision makings of leaders of the organization. They are also they are very influential too, like your key customer, your key supplier, the non-executive director. So this model is very important, and that's what we call Mendeley metrics. And you can remember in the words what I was talking about before, that the problem is that it's not because the stakeholders are many. The problem is that each of them is demanding for different things. What the shareholder is looking for is different from you as the employee you are looking for. It's different from what the manager is looking for. It's different for what the supplier is looking for. So each stakeholders have different things. But according to Mendeley now, that is the management scholar that developed these metrics, these 2x2 metrics that you're looking at now, is Mendeley. And he's just trying to advise organizations that you can't meet all of them. You can't meet their demand because there are many. And this is not even because there are many. It is because each of them is demanding for different things. That's the problem. So we now need to what? We now need to assess stakeholders now. We need to evaluate stakeholders now using their using the powers and their interests. That is, stakeholders' influence is determined by their by their powers and the interest. Powers and powers and interest. That's what determine the on stakeholders' influence. Stakeholders' influence is determined by powers and interest. And look at these 2x2 metrics. We have we have the high, we have the low for power. We also have for interest, we have the low and we have the high. If you have a stakeholders that have high power, Please, it is very, this model, this metric is very, very simple. But the key things here is about you, please try to understand the diagram. Once you understand the diagram, the explanation is not much. So the understanding of the diagram is very, very what? It's very, very key here. So now the first one, we have what? If we have the stakeholders that have high power, no, sorry, let's start from the first one. If you have the stakeholders that have low power but low interest, and sometimes your power is determined by the what your finance. That is, how much do you have? Do you really have money? That's your power. The interest is that, are you really, do you like what you are doing? Are you highly interested? That's your what? That's your interest. But your power most of the time is measured by the what? How much can you bring to that organization? How much can you provide to us if we need capital? So if you have someone that have a low power, since you don't really have money and you are not interested, you should do what? Minimal what? Minimal effort. Minimal effort. Low power, low interest. Minimal what? Minimal effort. Low power, low interest. Minimal what? Minimal effort. Low power, low interest. Minimal what? Effort. In terms of, don't stress yourself. Organization, if you can able to determine this type of stakeholders that have a low power and low interest, doesn't have money and is not really care about what you guys are doing. So minimal effort is that, oh, just be calm, don't stress yourself on that stakeholders. Be calm, don't trouble yourself. But if you have what, if you have the stakeholders that have what, high power, you have money, but you are not interested. Maybe if you have a portfolio, you have money, but you still have other investments, so you don't really attend to, let's say, XYZ Limited. But you have the money, you provide them a huge capital. But whenever maybe they are doing meeting or they are doing anything, you don't usually attend because you are very, very what? You are very, very busy. So organizations should keep you what? Certified. If you have someone that have what? High power, it is you have money, but you are not really interested. They should keep you what? Keep you certified. Keep certified. You have to do everything for you. You must not go. That's what God keeps certified. The stakeholders that have what? High power and what? High power, low interest. But if you have a stakeholders that have what? That have high power, it is you have money, and you're also interested about that organization. Your interest is high. Your power is also high. That means that you're a what? You're a key player. That's what we call what? Key player. High power, high interest. That's what key player. You're a key player. You have the money. Wow. And you still have the interest. Your interest is still very high. That means that you are a key player. But if you have a stakeholders that have what? That have low what? Have low power. You don't really have money. Maybe you don't really have money that for you to take this online course. You don't really have money, but you are highly interested about this online course. What I can online tutors should should do for you is that they must keep you what? They must keep you informed. Whenever a new diet lecture is about to take off, they should do what? They should keep you informed, because if you do not have money today, you can have money tomorrow. So they should keep you informed. Your interest is high, you like it, you want to attend this class, but the money is not there. So what I can online tutors should do for you is that they should keep you what? They should keep you informed, because if you don't have money today, you can have money tomorrow. So this is what this Mendeley matrix. Please try to understand the diagram. The diagram is very, very key. If you have stakeholders that have low power, low interest, what you do, minimal effort. Don't stress yourself. You don't have money and you're not interested. Wow, can go. Another one, if you have a stakeholders that have high power or low interest, what should we do? Keep certifying. You have to certify it. Because of what? Because of the power, because of the money that you have. But you are not interested. But if you have a stakeholders that have high power and what? High interest, you have the money and you are still interested. Wow. You're a what? You're a key player. But if you have someone that have a low power, you don't really have money, but you're highly interested, they should keep you what? They should keep you informed. So this is what this Mendeley matrix. Please try to understand the diagram very well. If you understand it very well, there's no problem. So another thing that we also need to talk about briefly is that Stakeholders conflict. Stakeholders usually fight, but conflict in terms of each of them is demanding for different things. Each of them is demanding for different things. That's what's called conflict. This one is demanding for, okay, I want higher salary. This one is demanding for, okay, I want high dividend. And all your problem, it is still this one organization that you do what, that you'll be charging it to. All your problem is charged to what? To this organization. So there's conflict. Look at what employee now, employee versus manager. We have what conflict is about jobs, it's like what wages versus what bonus. As employee, you'll be thinking about what wages. The manager will be thinking about, well, okay, I want what I have to give me bonus. You can see that there's a conflict. What this one is demanding for is different from what this one is, or what this stakeholder is demanding for is different from what this, or what employee is demanding for is different from what supplier is demanding for. What stakeholder manager is looking for is different from what customer is looking for. What government is looking for is different from what the public is looking for. So there's a conflict now. But the problem is that there will always be conflict. How can we now resolve this one? How can we now resolve this conflict? And there's a management scholars, which is named what? There are two management scholars, we call them what? Stride and what? And match. They suggest what? 4 ways to resolve what? Conflicts among what? Stakeholders. These are the way that you can resolve what? You can resolve stakeholders conflict according to what? Citing and what? A match. Let's say first one, certify. Certify involve what? Negotiation between what? Key stakeholders to arrive at what? Acceptable compromise. That is, they have to be what? Negotiation. Let's negotiate with them because what you are demanding for is different from what this one is demanding for. So an organization now, we can't meet what? We can't meet everything at what? At the same time. We can't meet everything at what? At the same time. Why? Because well, we cannot involve in one. We cannot enter a negotiation with, okay, employee now, you want higher salary. Okay, please hold on. When it is what? 2022, we are going to increase your salary. Okay, manager, what do you want? Okay, I want this. Let's enter a negotiation. Let's involve a dialogue with them. Okay, let's come together. Oh, this is our problem as organization that we are facing now. Your demand, we can't meet that now. Let's negotiate with you. By next year, customer now, you are demanding for another future. Employee now, you are demanding for salary. Supplier now, you are thinking, oh, please, I want to increase my cost price of the product that I'm supplying to you. Let's involve people. Let's involve a dialogue with them because we can solve it. So that's the first word. That's the first suggestion of this management scholar. It says certify, involve what? Negotiation between what stakeholders to arrive at an acceptable what? Compromise. Another one has to do with what? Substantial what? Action. Is when management focus on what? On stakeholders' need in turn. For example, staff may receive a what? A pay rise with a clear implication that it will not be turned again for what? For a few years, so that they should not expect any further what? Increase. In terms of what? Substantial what? Attention. Okay, you want salary now. You want high salary in 2021. Okay, we are going to increase your what? Salary in 2021. But in the next 5 years, don't ask for increase. That's another way we can resolve what? We can resolve conflict, stakeholders conflict. Okay, so that's what we call special what? Attention. Okay, I'll attend to you now. But once I attend to you, in the next 2 years, don't come and meet me. That's another way that was suggested by this management scholar. Another one has to do with what? Slight payment. Slight payment are where the stakeholder primary objective cannot be met, so that they are compensated in some other way. For example, a local community may object a new factory being built on a site that will cause what? That will cause pollution, noise, and what? Extra traffic. A firm may continue to build a factory, but try to appeal the community by also building what? Local sports facility. That is, if you do something, okay, look at this example now. The local community, they don't want you to build a factory because it will cause what? Cause pollution, noise, and what? To cause extra traffic. So what you can do is that you can build a factory. but you also need to give them in something in what in return. That's what we call what slide payment. I'm going to build a factory, but I can establish a hospital for you. I can build a stadium for you. So you give them something in what in return. And another one, which is the fourth one, has to do with what exercise of power, is when a deadlock is resolved by a senior manager, forcing through a decision simply based on the power they possess. At least you can resolve conflict. And this is the last one. This one is not really what, if you look at it very well, it's not really good because through your power, you say, okay, I'm not paying you this, I'm not paying you. If you like, you can live in life, you can what, you can stay. That's where you can resolve what? You can resolve stakeholders' conflict by using what? Exercise of power. You can exercise your power. Please don't forget this. So these are ways you can resolve what? You can resolve stakeholders what conflict. In terms of when we say conflict, is that each of them is demanding for different things. So, and this is how you can resolve this by that was suggested by citing and what and match. These are the four ways you can resolve what stakeholder conflict. So another thing that we also need to talk about is that we need to talk about collaboration. When we say collaboration, we all know that when we say to collaborate, and that's one of the beauty things in what in management. There's something that is not necessary. I told you from the beginning of this class. It's not necessary for you to read it before you can answer it to the exam. If you are familiar with your pathfinder, there's something that the examiner will ask in management. That is not necessary for you to read it. What you just need to just try to understand it. And if I ask you what is the meaning of collaboration, I'm very sure everyone here will be able to say something. So collaboration. I say in a competitive market, company need to achieve a competitive advantage over competitors in order to succeed and survive. In some situation, company might be able to achieve competitive advantage through collaboration. This collaboration is that we can come together. I can collaborate with my suppliers. You can collaborate with your customer. You can collaborate with other business entities. You can collaborate with other competitors. So that for you to achieve for you to achieve your competitive advantage. And when you get to skills level by God grace, next time there's a model that we call that is, I think we call this Grana's growth model. That is, how did the organization grow? Organization can grow through collaboration too. You collaborate together. And when you are collaborating together, the main purpose of collaboration is for you to achieve your competitive advantage. You can collaborate with your suppliers. You can collaborate with your customers. You can collaborate with other business entities. You can even collaborate with your competitors. Collaboration with suppliers and customers can create additional value in areas such as product design, delivery time. Suppliers and customers must collaborate to improve to improve the product design by improving the design of product components or providing a better raw material. Delivery time. Suppliers and customers might collaborate to improve the reliability and the speed of delivery. For example, just-in-time purchasing arrangement. Some of you that are doing management information, this will not be new to you. We have what we call GIT. And the idea of GIT is that we don't want to have we want to eliminate closing inventory. We don't want to have inventory. We want to eliminate inventory. And just-in-time can be divided into two. We have what we call just-in-time purchasing, and we also have just-in-time production. Just-in-time purchasing, that you only purchase raw material if it is needed. And just-in-time production, that you only produce if it is needed. You only produce when you have received order from your customer. So collaboration is very, very important. And you can collaborate with your customer just to achieve this objective for product design and for delivery time. We also have collaboration and strategic alliance. And when you say strategic alliance Strategic alliance is what is an arrangement in which a numbers of what separate companies share their resources and activities to pursue a joint strategy. By collaborating, all the companies in the alliance are able to offer a better product or service to their customers. Please don't forget this. When we say strategic alliance is an arrangement in which a numbers of separate companies share their resources and activities to pursue a joint strategy. That is, Dangote can come together now. Boa can also come together now to achieve a joint strategy. And this strategic alliance is generally used by companies in the same industry. For example, now Dangote is in let's say Dangote, we have Dangote cement, we also have Portland cement that was made by Boa. So now two of them can come together now. That's what we call to pursue a joint strategy that is known by that is known to the parties. So organization will share their resources together. They are going to share they are going to share their idea. They are going to share their technical know-how together. That's what we call strategic alliance. And I've given example of what strategic alliance that we also achieve. Example of strategic alliance in the airline industry, where a group of companies might form a strategic alliance in order to offer a travelers a better section of routine and facilities. We have a strategic alliance by British Airways, American Airlines, and others. So please don't forget, when we say strategic alliance is an arrangement in which a numbers of separate companies come together to achieve a joint strategy. And we also have another one called joint ventures. When we say joint ventures is a form of ventures by two or more separate entities to develop a business or activities jointly. When under strategic alliance is to achieve a joint strategy. But under joint ventures, and there's accounting standard for this when you get to professional sales, we call it IS 12 joint ventures. I'm sorry, IFRS 12 rather, I think so. And when we say joint ventures, we usually have venturers in terms of we have venturers that will come together. So a joint venture is a formal ventures by two or more separate entities to develop a business or activities jointly. Many joint ventures are established in form of separate company, which is jointly owned by a joint ventures partner. And if you can still remember, if it is your financial accounting, we have what we call joint ventures accounts. And when we say joint ventures, usually very similar to partnership, where they are different. So we have joint ventures account, and we have the two ventures. We have ventures A, we have ventures B, and the rest. Joint ventures are frequently used for investing in a new business ventures, where there's considerable risks, large amounts of capital is needed, and to mix of skills is essential. That is, me now, maybe I'm good in financial reporting now. You are good in strategic financial management. We can come together. There's a need to have a mixture of skills. Large amount of capital may be required. The risk is may be high. So that for me only going to let's just have parties that we are going to share it together. But it's going to be It's going to be a new business. At least we can have a new business for now? Let's be selling nose marks. And one of the features of joint ventures is that business organization is usually established for short period of time. You don't usually joint venture is not usually established for a long period of time like partnership. But it's just for to make a short profit. Once you see a new opportunity, two of each parties can come together, and once you make the profit, you exist. So there are several advantages of using entering a strategic. There are several advantages in entering a foreign market in a strategic alliance with a local company. Let's say, for example, when we say strategic alliance is that two of you will come together to achieve a common strategy. So let's say now you can be in US, me I'm in Nigeria. So what will now be the advantage that we are achieving a strategic alliance through that medium? I say it might be a legal requirement for foreign companies setting up business in the country to operate as a joint venture with local companies. And the key thing here is that, please don't forget, when we say strategic alliance, let me still take you to that. In terms of strategic alliance, is that two parties come together to achieve a joint strategy. Look at it. A strategic alliance is an arrangement in which a numbers of separate companies share their resources together and activities to pursue a joint strategy. And by collaborating, all the companies in the alliance are able to offer a better product or service to their customers. It's to operate in what? So what will not be the advantage than that? Okay, let's say one company is in Nigeria now, one company is in the US. What will be the advantage? And there's advantage to it, but I didn't include the disadvantage. Or you guys also can know it. Okay, there's strategic alliance now between a Nigerian company and a foreign company. What will be the advantage? And what will be the disadvantage? Like just say, for example, now you have let's say it's a group account now, where we have we have the parent company and we also have what we call the subsidiary company. Let me say I'm a parent company now, I'm in Nigeria, then I have my subsidiary is in US. What will be the advantage relating to that, and what will be the disadvantage? Another thing we also need to talk about is we also have what we call franchising. And this one is very, very it's very, very popular, especially in especially to which industry can I remember? Like in the food, where you have you can have KFC, you have KFCs in Nigeria, but KFC is not it's not a Nigerian company. But you can do we can do franchising. Some business entity may be able to grow through franchising. This is another form of collaboration. The basic idea of franchising is that a company develop a product with the following feature. It is a standard product or a range of products delivered to customer in a standard way. It has a brand recognition, and everybody let's say in the abroad know KFC. So if I are able to use their name, and I also have a KFC in Nigeria, people may try to patronize me. So once that's one of the features of using franchise in terms of maybe the brand is highly recognized, and the brand was highly recognized. If you want to use, let's tell ourselves the truth. The brand are usually they are very, very organized. That it is well known. And another one has to do with the system of delivering. The system of delivering the product to the customer are standardized using standard equipment and standard work practice. That is, maybe you want to do your pizza now, there's a little a percentage of salt that you're going to add, it must not be more than that. So there's already standardized way. And customer went to buy it in terms of due to their brand name, due to their recognition. Oh, if I'm selling pizza in this social location and using Domino as the name, people like to patronize it. And look at this example. It's in your pack also. They say the most well-known example of franchising are some of the fast food restaurants, such as we can have McDonald's. McDonald's is not a Nigerian company, but we can have McDonald's in Nigeria. So that's that's franchising. We also have licensing. License. I say in license, this is a typical license arrangement. A license is giving permission to a licensor to make goods, formally making use of the patent process, and to use the appropriate trademark on those goods. In return, the licensor receives a royalty. The license is exposed to relative little risks or goods can be made whenever the license is located. So license, I can give you a license now that you can be extracting crude oil. Maybe federal government can give you a license to be producing a certain material now or a certain product. And another one, which is the final one, we have the word cartel. Cartel. A cartel is what is an arrangement between a rival firm in an industry to operate the same policy on what on pricing by operating what a pricing cartel. The firm are able to charge higher price than if they competed with what with each other. As a result, make higher profit, provided the cartel include all the firm in the what in the industry. In terms of what we are talking about is that there can be a cartel related to price. Price in terms of everybody. Okay, let's say we have what? We have 10 companies that are producing what that are producing biscuits in Nigeria now. So there can be a pricing cartel that all of us we are going to have agreement that one biscuit we must not sell it at less than what? Less than 15 naira. And the main reason of using that pricing cartel strategy now is that for us to make profit so that there's going to be arrangement between every one of us that we can't sell our product between what's below 15 naira. So that means that all the producer is going to have what? It's going to have arrangement that our products cannot be sold above what? Above 15 naira. So that's what we call cartel. So in end product, things that we discussed today, let's make it what a brief summary of everything before we head today's class. And today we talk about what? Today we talk about business organization. Talk about business organization. Business organization, talk about the business organization can be divided into two. We have the what? We have the private, we have the commercial, and we also have the what? We also have the non-for-profit making organization. When we say the what, when we say the commercial organization, we talk about their purpose. The purpose in terms of what is the purpose of establishing that organization? The purpose of establishing that organization is to make what? Is to make profits. It's profit motive. We also talk about the ownership. That is, the ownership is being owned by what? It's being owned by the provider of finance. We also talk about the what? We also talk about business entity. In terms of we talk about the private, we talk about we talk about the sole proprietorship, we talk about the what? The partnership, and we also talk about company. We also say that company is divided into two. We have the private and we also have the what? The public. Another one is we also talk about the memorandum of association, talk about the article. The memorandum of association is a work document that shows the relationship between the companies and the outsider, while article of association is what is internal rules. And we talk about the content, and we also talk about the content of both memorandum and what articles. We also talk about the futures of private, and we also talk about the future of public. One of the features of private is that the minimum member is what is 2, while the maximum is what is 50. It is used LTD, share cannot be what you can't transfer share. You also talk about the public in terms of what it's end with PLC. You can transfer share, you can invite the public to buy your share. And we also talk about stakeholders. We talk about the internal, the external, and the connected. So stakeholders is anybody that can be affected or be affected by any decision of that organization. We also talk about the Mendeley matrix, which is the 2x2 matrix. 2x2 matrix where stakeholders' influence is determined by the powers and the interest. So please, the key things here is about you was understanding the diagram. We also talk about the conflicts. That is, two of them, this stakeholder, they usually fight because what this one is demanding from is different from what this one is looking for. So we talk about what stakeholders conflict. We also talk about different form of collaboration. And the main things of collaboration is to achieve what? Competitive advantage. You can collaborate with your customer. You can collaborate with your supplier. You can collaborate with your suppliers. We also talk about joint ventures, strategic alliance, the cartel, the franchising, the licensing. And this is where we are going to work. This is where we are going to stop for today. So thank you very much. the slide will be what to be shared with you. So please make sure you go through it. If you have any question, you can you can let us know and be able to what to resolve it. Please, this is what make sure you read the slide very well. It is very, very important. Don't forget the word the stakeholders. The stakeholders is very important. Know the internal, know the external, know the stakeholders metric. Don't forget about the content of memorandum and the content of what article. Don't forget about the classification of business organization. You can have the not-for-profit making and you can also have the commercial. So thank you very much and God bless you. This is where we are going to work. This is where we are going to stop for today.
Thank you, Abdulwasi, for that lecture. We hope to see you next week again. Have a
Yeah.
lovely day. Bye.
Okay. Thanks.